Welcome to this explainer. Stop waiting, start building. Today we're looking at mindset and the 20-year wealth reality.
Okay, I want you to ask yourself a really tough question right off the bat. Am I really living, or am I just kind of existing? Look, your time is limited, and honestly, nobody is coming to save you. Hitting snooze on that alarm every morning is just slowly destroying the life you're dreaming about. In this explainer, we're going to break down the absolute urgency of taking control of your life right now, and then we'll follow that up with a hard, 20-year mathematical look at how wealth is actually built. We all want freedom, right? Success, peace of mind, but what are you actually doing today to get there? Are you just endlessly scrolling, making excuses, maybe waiting for some magical perfect moment?
So, let's get right into Act 1. The clock is ticking. Because honestly, before we can even begin to talk about money or investments, we have to wake up and face the brutal truth about how we actually spend our time.
It goes like this. You aren't killing time. Time is killing you. Literally. Every single time you say, I'll just do it tomorrow, you are feeding the absolute laziest version of yourself. It's a daily you versus you battle. That little voice in your head saying later is really just fear. It's trying to trap you in a cage of overthinking. And let's be real, later usually becomes never. Time isn't your servant. It just ticks away, eventually leaving you with nothing but regret.
And this perfectly highlights the fundamental difference between people who stay stuck and people who win. People who make excuses, they love to blame a lack of support or a lack of money or how they were brought up. But the people who actually take action, they refuse to be victims. Think about Oprah Winfrey, born into extreme poverty. Or J.K. Rowling, getting rejected 12 different times before anyone would even look at Harry Potter. They didn't wait around for permission, right? They picked themselves up and built something incredible from absolutely nothing.
To pull that off, you got to realize that willpower is just a muscle. And like any muscle, you have to constantly train it. If you let your feelings dictate your actions, well, you've just handed your entire future over to your mood. You've got to starve your distractions and start feeding your focus. It means you stop comparing your messy, everyday, behind-the-scenes reality to someone else's totally curated 15-second highlight reel. You have to do something uncomfortable every single day. Fail. Fail proudly and fail loudly. And maybe the most important rule, think for 10 minutes and then act for 10 hours.
All right, let's pivot to Act 2, the mechanics of wealth.
Let's see exactly how this disciplined mindset applies to the real world by diving into a 20-year financial case study. I want you to meet two 28-year-olds, Ethan and Lucas. So both of them earn $65,000 a year. Both live below their means, and both have actually disciplined themselves enough to save exactly $50,000. It's the biggest financial milestone of their lives so far. But here's where they split. Ethan is taking the active path. He's taking his money and putting a 20% down payment on a $250,000 rental house. Lucas, on the other hand, he's taking the completely passive path, dumping his entire $50,000 into a total stock market index fund.
We are going to track their exact financial progress across 4 distinct milestones, from day 1 all the way out to year 20, just to reveal the hidden realities, the actual stresses, and the real math behind both of these investing styles.
Okay, day 1. Ethan looks like the undisputed champion. He locked in a 30-year mortgage at 7%, meaning his payment is roughly $1,330 a month, but he immediately found a tenant paying $1,800 a month. This leaves him with a totally glorious, exciting $470 monthly profit right out of the gate. Meanwhile, Lucas, he just gets a super boring confirmation email from his brokerage app. Nothing exciting to look at all. But then a massive reality check hits by year 3. Over those 3 years, Ethan has collected roughly $64,800 in rent. After his mortgage payments, he's got an on-paper profit of nearly $17,000. But, and this is a huge but, that number only exists on paper. In reality, it gets completely devoured by the hidden iceberg of property ownership.
Because rent minus mortgage is just the very beginning of the math. Down underneath the surface, routine maintenance costs about 1 to 2% of the property's value every single year. Then you've got property taxes, insurance premiums, and, sudden midnight plumbing emergencies. These quiet expenses totally eat away at that easy money. But honestly, worse than that, they fiercely tax his willpower. The pure stress of active management drags his actual cash-on-cash return down to a much more modest 3 to 5%.
And man, let's talk about what happens when that property sits empty. Ethan gets to experience the painful, exhausting cycle of vacancy. A tenant moves out, and suddenly zero rent is coming in. But guess what? The bank still fiercely demands that mortgage payment.
Then he's writing checks for fresh paint, deep cleaning, paying to advertise and screen new tenants. Just one single month of vacancy can easily completely wipe out months of his hard-earned profit.
But here is exactly where Ethan's active strategy actually pays off: leverage. By using borrowed capital, his $50,000, to control a $250,000 asset, his equity climbs to a really impressive $80,000 to $85,000 as the house appreciates and his tenant pays down the loan over those first few years.
Meanwhile, what is our guy Lucas doing? Well, his journey is completely invisible and, honestly, pretty boring. He just sets up an auto transfer to add $200 every single month to his index fund. He deals with 0 tenants, 0 plumbing emergencies, and absolutely no stressful weekend phone calls. From the outside looking in, his friends don't even know he's investing.
But by year 7, the absolute magic of compounding shifts into high gear for Lucas. His portfolio hits roughly $120,000. What that means is his money is now generating more automatic growth than his own $2,400 annual contributions. His money is literally making its own money, completely independent of his time, his physical effort, or his daily willpower.
So, year 10. We check back in on both of them, and wow, they are remarkably close. Ethan has fantastic equity, roughly $165,000 to $200,000, but he has had to spend about $30,000 on taxes and repairs while carrying massive debt and some serious high stress. Lucas, however, he just quietly let a 10% average market return build his liquid wealth between $170,000 and $180,000, with absolutely 0 surprise costs and 0 stress.
All right, let's jump all the way forward and look at that incredible 20-year finish line. Ethan finishes up with approximately $555,000 in total wealth between his property equity and his net cash flow. Lucas finishes with approximately $518,000. I really want you to think about that for a second. We just watched 2 wildly different paths with totally different stress levels lead to almost the exact same financial destination.
Ultimately, what this explainer really highlights is that building wealth is just about choosing your hard. Ethan accepted concentration risk, literally putting all of his money into one single house in one single neighborhood, and he invested massive amounts of his own personal time alongside his money. Lucas, he had to accept extreme market volatility. He had to stomach watching his portfolio absolutely plunge during the 2008 and 2020 crashes without panicking, and he invested his patience.
Neither approach is automatically better than the other. The true winner isn't determined by the asset class itself. The real winner is the person who understands the time, the stress, the risk, and the opportunity cost involved. It's the person who picks a strategy that actually aligns with their temperament and then just stubbornly sticks to that plan for decades without making any excuses.
Which brings us right back to exactly where we started. The clock is ticking. The world does not care about your potential. It only rewards your performance and your discipline. Life does not owe you an easy path. So my final question to you is this: knowing the realities, knowing the hidden costs, and knowing the absolute necessity of taking action, which of these paths are you going to start building right now?